Hi, good evening, and welcome to a new month. We are into the start of Q3 2025. We have already witnessed quite a dramatic activity in the month of May. For equity market, it did not really gain a lot of ground except for the Nasdaq. So today we're going to do a little bit of a recap as to what happens and what has transpired in the month prior. Okay, before we go into Q3, time has really fly, and we really got to watch what's happening. Now, before we go into the content itself, let me remind you that this presentation is not an offer to buy or sell any kind of securities, be it FX, CFD, crypto, or any kind of margin financial products, and they do carry the risk of loss. The opinion that I'm going to share with you later on throughout this presentation are purely mine and has got nothing to do with the sponsor, which is IronFX, which has been very generous in sponsoring my events for quite some time now. And of course, the content of this presentation has not been vetted by any regulatory body. So with that, let's get started. Now, before we go into the chart itself, let me recap what has transpired as far as the economic data are concerned and whether there's any news of particular importance. Okay, first off, we have a very busy week in which various members of the Federal Reserve Open Market Committee has actually given their views as to whether the monetary policy will be changed in view of the very destructive nature of the tariff policy since Liberation Day on April the 3rd. Now, this is definitely somebody that we want to watch. His name is Kevin Maxwell Walsh, and he appears to be President Trump's potential successor once the current Fed Chairman Powell finish his term, which is going to be in 2026. So whether there will be, by announcing his candidacy so early before the end of Powell's term, it will be a little bit destructive because any view that this guy is going to be giving is definitely going to make the job of the current chairman a lot more difficult, okay, because he is slated to be the incoming Fed chairman, okay. So again, this will be the guy who was previously a Fed governor from 2006 to 2011. So his view will definitely be moving markets. If he expressed a view that is very different from the current view from the Federal Reserve, then it will be very destructive. Obviously, this guy, Kevin Maxwell Walsh, is somebody who has a view that very similar to President Trump. Okay, that means it is definitely in the opposite direction of the current chairman Powell. Okay, so he has been highlighted to be the guy to watch, and his view will be very much watched by media and analysts. Now, going forward, we knew that last weekend before the before the week was out, President Trump actually suddenly announced that he is going to impose a 50% tariff on the EU. Now, within less than 48 hours, he actually flipped. Again, nothing unusual about that. We are getting used to President Trump's turnaround in terms of his views of various things. Sometimes within 24 hours, he will change his mind. So it's very difficult to actually trade based on every comment that he puts up, because his comment will definitely move markets. But if you're going to be trading based on his every tweet, which is very popular, sometimes coming in the wee hours of the morning, this is going to be very difficult to base a policy based on such flip-flops. Okay, so true to character, within 48 hours, he came out and said he would delay, okay, the 50% tariff that he just mentioned this time last week, okay, on the EU until July the 9th. Okay, so again, not sure what will happen for the next one and for the next 6 weeks going into July the 9th. Okay, so this has actually caused equity markets to come off because the EU definitely is taking a very hard stand, meaning to say they would definitely fight the United States. on tariff. But again, we will have to watch what will happen, okay? Because as much as the EU wants to be tough in retaliation to the US tariff policy, there's very little that the EU can do, honestly, okay? Because they just simply don't have the cards to play against President Trump. Okay, so we will have to watch how this thing unfolds leading to July the 9th. Okay, then this will be another voting members of the Federal Reserve Open Market Committee. His name is Neil Kastari, and he is the Reserve Bank's president of Minneapolis. Okay, so he called for interest rate steady, meaning to say he's not in favor of moving the needle on interest rate policies. So he also wants, very much parroting what Powell is saying, he wants to watch the data as far as the impact on the tariff is concerned. Okay, so if that is the case and he is a major voting member of the committee, then his words do carry some weight. Okay, so far we have seen that the various member of the FOMC has actually given some of their views. The majority seems to be in favor of keeping things the way it is right now and watching the data as it comes in. We all knew that data will not necessarily be able to reflect the true situation on the ground. It may take anywhere between 5 to 6 months to see the data showing up. As to whether the impact of the tariff policy is going to be negative or is it going to be not so dramatic. Okay, so we will continue to watch this space here. Now, this week we have the minutes of the last FOMC meeting, which was last carried out in April. We knew that the majority is still adopting the same messaging, meaning to say that they will like to watch further the details of the data coming in, whether it is inflationary data or whether it is employment data. About employment, this coming week, we are going into another labor report, which is likely to be able to provide us with some fireworks. Okay, we have already seen the inflation data. It has been nothing dramatic. In fact, for some of the indicators, it does suggest that the inflation impact has been quite muted. So now we want to be focused on the labor front, whether it is going to cause more layoff or whether is it going to see a spike in unemployment. Okay, so again, we will continue to watch this coming week. It's going to be very, very interesting. Okay, now out of nowhere, okay, this thing came out of nowhere. Nobody expect this to happen. A court, okay, not a major court, okay, but this court is so obscure. Nobody has actually been focusing on that. It's called the U.S. Court of International Trade. Has suddenly, without any hint, actually came out, okay, and ruled that the various tariff that President Trump has imposed since Liberation Day, what he called the reciprocal tariff, they are illegal, okay, and the administration must stop uh, imposing tariff going forward, including those tariff that they have collected since April to be reimbursed back to the various companies that has been subjected to tariff. And within 24 hours, we knew that Trump being Trump has actually retaliated, or rather he actually make an appeal, which is currently standing. Okay, so right now the court said that within 10 days, okay, he must stop all these tariff. But within the next 24 hours, we have another court that overruled this Court of International Trade and suggest that the current tariff will remain in place for review. Okay, the plaintiff are all the Democrats, senators, and congressmen that has and companies that's actually sued. Okay, the Trump administration for the so-called illegal tariff. Okay, so as far as the plaintiff is concerned, by next week, June the 5th, they will see whether they're going to appeal this. Okay, as far as Trump administration is concerned, they will have until June the 9th, okay, to to counter appeal any kind of successful appeal by the plaintiff by June the 5th. Okay, so June the 5th and June the 9th will be the two dates to watch. And don't believe that this is going to be easy. Any kind of litigation is going to take time, and it's going to be quite lengthy. Okay, so from liberation to litigation, we have seen how divisive this issue has been as far as the small medium enterprises are concerned. A lot of small businesses has actually fallen because of this tariff. So I think going forward is going to be very, very destructive if we're going to see the judiciary arm of the US government going to be fighting the administration. Okay, so again, it's going to be very destructive. Then again, we have again something that out of the blue, okay, Trump's decided that he wants to double the current tariff rates on steel and aluminum from 25% to 50%, and this is universal. But I think it will definitely hit the current 90 days pause between the US and China. Okay, China is definitely not happy with what has been unfolding since the so-called agreement between the US and China after their meeting in Geneva. Okay, so President Trump has recently made another remark saying that the Chinese has actually violated the so-called agreement, even though there was no signed agreement between the two parties. Okay, I think his major issue is that the Chinese has not loosened up their licenses for the export of rare earth minerals. Okay, and this is something that China knew that they cannot easily agree to, because this is a major trump card. Okay, so the Chinese side would definitely want to hold on to this until they can wrestle some kind of real concession from the United States. Okay, and on top of that, Trump actually says that he's going to ban the export of aircraft technology, including jet engine, to China, and this will definitely directly impact Forex, which is the Chinese company that is developing the C919. Okay, so again, things are not looking bright, and it has the real potential of unraveling everything else that was agreed in Geneva between the two countries. Okay, so things are not looking that bright. Okay, then the other thing is that Nippon Steel has always been wanting to buy U.S. steel. President Biden stopped it. President Trump stopped it in the early part of his second term. But now it seems that he's agreeing to this Nippon Steel taking over U.S. Steel under the name of Nippon Steel investing in the U.S. Steel. We all know it's just a play of word. It's basically Nippon Steel taking over U.S. Steel. Okay, so again, different wording, but it has the same impact. Although he says he has not fully signed on that deal yet, but the messaging is that he will allow the Nippon Steel to actually be able to take over the US Steel. Now, the Japanese are definitely playing hardball as well, very much like the EU. After the United States has refused to eliminate or to forego the 10% universal tariff on Japanese export into the United States. This will definitely impact their automobile industries. And the other thing that the Japanese are not happy is that the US insists in the Japanese opening up their agricultural sector to US export. We all knew that the agricultural sector is has a lot of votes, okay, for the incumbent parties, okay. So in Japan, no politician has ever survived if they sacrifice the farmers. Okay, so it's going to be very, very difficult for them to come to an agreement. Trump is digging in, so are the Japanese. So going forward, we definitely have seen the impact of the Chinese playing hardball, the EU playing hardball, and now we have Japan playing hardball. Okay, the only one that may actually strike a deal with United States with a signed agreement looks increasingly likely to be India. Okay, so India is playing a different set of cards after their brief skirmishes with Pakistan, which resulted in quite a bit of a humiliation for the Indians military. I think they are trying to play the role of a spoiler. Okay, and that will mean that they will likely lean towards the United States, which will be more than happy to play the Indian card. Okay, so we will have to continue to watch the geopolitics because it's getting a little bit sticky with development not only in Ukraine. We are seeing a brief war between Thailand and Cambodia this past week. Okay, so not sure whether currently there is a ceasefire between the two, but we do not know whether it will re-flare up again. Okay, then of course we all knew this weekend we have the Shangri-La summit in Singapore, in which the US is very high key flying in the defense secretary Pete Hegseth in that doomsday plane, okay, which is actually used to conduct nuclear war. Okay, he flew into Singapore on that plane to send a very strong message. So although the Chinese did not send their defense minister to this year's Shangri-La summit, they definitely are not absent. Okay, uh, the wordings and messaging that come out from the 2 days meeting is definitely very much in line with what the US and NATO is trying to do in this part of the world. Okay, they are trying to tell the Southeast Asian and the Asian that China is a major problem, and they need to bump up their defense spending to 5% of their GDP. Okay, so things are not looking good in this part of the world. Over in the Middle East, Israel has been itching to hit the Iranian nuclear facilities. Right now, the US is telling the Israelis saying that they should lay off because the US feels that they are very close to striking a deal with Iran, mainly to tell the Iranian to give up the uranium, okay, which is the key element in the nuclear facilities. Okay, the Iranian definitely are not willing to give up that part. Okay, so they have been back and forth. Correspondence between the US and Iranian. This is the fifth meeting they had, and it seems that they are no nearer to an agreement. Okay, so again, while we are watching the economic play out, we also need to also constantly monitor the geopolitics, because as we go into June, it's going to be very hairy, because in terms of the cycle itself, it does appear that June is going to see something not pleasant going to happen. Okay, and that will have a repercussion on a lot of asset classes, in particularly the equity markets and of course the gold market. Okay, we want to continue to watch this. Now, the first data that come out for this past week has been the GDP. This is the second reading. Okay, there has been a bit of a climb down. We can see that the GDP for Q1 2025, okay, is marginally lower than the first reading, which is negative 0.3. Now it's revised to negative 0.2. It's definitely a reflection of where we are right now. Now, remember in Q4 of 2024, the GDP for that particular quarter was 2.4% positive. Now it is deeply in negative territory. And the first revision is not necessarily a plus, because we can see that it confirms what the first reading has been telling us, which is that the US economy have actually shrunk, and it has shrunk dramatically. So we are done with Q2. Over the next couple of weeks, we would by June 23rd, we should get the third reading for Q1 GDP. So somewhere in July, we should be able to see whether Q2 is any better. Okay, so Q2 is down, Q1 is down. We will be watching the Q2 in July. The last revision will be done on June 26th for the Q1 GDP. Okay. Then we have the core inflation, which is the core personal consumption expenditure. This is the month over month. We can see that it has actually climbed up a little bit, okay, from 0% to 0.1%, which is very much in line with expectation. However, we can see that the year over year, so this is year over year, is 2.6, currently it's 2.5. So that comes up a little bit. So this is the This is the second climb down in the core personal consumption expenditure year over year after it hit a peak of 3% in February. So this is the second a month in a row that we can see that the core PCE numbers year over has actually declined. So is this a good thing? Uh, Depends on how you look at it. While it is used to measure inflation, it can also be used to suggest that the US consumers are spending less and they have drastically reduced their spending, okay, which did not show up as inflation. It showed up as a decline in consumption. Okay, so if you look at it from this perspective, it is a warning that the US consumers are definitely tightening their wallet. And this is, if this is the case, it's going to be bad because at 2.5%, you'll notice this is the lowest over the last, since the beginning of 2024. So 2.5% is even lower than what we saw in June of last year at 2.6%. So it's definitely a reflection of US consumer getting very cautious, and that shows up as a lower PCE numbers. Okay, so again, I think the US consumer are definitely on the road. Okay, so overall, we see that the Dow Jones itself has climbed up a little bit. For the whole month, it's up 2.3%, but year over year, it is still in negative territory, but just under where it was at the close of December 31st, 2024. So it has largely climbed back clawed back most of its losses. Remember when the Dow Jones was at 36,612, the Dow Jones was more than double-digit loss. Okay, so it has basically climbed back and clawed back all the losses that we saw during the part where the Liberation Day tariff were imposed. Okay, first the 90-day pause, followed by another 90-day pause between the US and China that has created the buoyancy. Okay, but if you remember earlier on, I did mention that the progress between the US and China has actually stalled. Okay, so that will actually brings back the possibility of some kind of harsh languages being exchanged between President Trump and the Chinese side. Okay, so this could be detrimental to equity markets going forward, but we will have to watch. Technically speaking, the chart itself looks very positive. Okay, although the risk to the downside is an escalation to something that we are so aware what President Trump can do. Okay, he's definitely the elephant in a China shop, so it's going to be difficult. Okay, so in the S&P 500, we can see the S&P 500 has also gained quite a fair bit this past month. For the month of May, it gained almost 4%, did even better than the Dow Jones. Okay, and year over year, it is still in negative territory, but only marginally. Okay, so the sharp rebound from the low of 4,835 in April has actually been erased, and we can see that it is getting ready for higher prices, technically speaking. Now, the one that actually gained a lot of grounds are the tech stocks, excluding Apple. Okay, so the National 100 has gained the most, 6%. Okay, we can see that it is not that far away from its all-time high, 22,222, which was traded 5 months ago. Okay, sorry, 3 months ago. So we can see that the National has performed very, very well. The reason why Apple is not included in this has not benefited a lot is because last week we have President Trump coming in to say that he wants to see Apple producing iPhone, not in India, okay, but in the United States. And we all know the cost of production in the States is so high that it is almost going to be impossible to make money for Apple, okay, if they have to produce their iPhones in the state side, okay. So this is setting the stage for further gains. Technically speaking, it looks very, very positive. Later on, when I show you the chart, I can tell you why it looks very positive. Okay. So this is I believe this is the national, right? This is no, this is spot go. Sorry, this is spot go. Spot go has gone flat. Okay. Last month it did not gain anything at all. In fact, it was flat for the month. Okay. Year to date, it has come back down a little bit. At the high itself, it was up 28%. Okay. Now it is only up 27%. So we can see that gold prices has stalled, okay, whether it is getting ready to continue to consolidate or whether it's getting ready to resume its uptrend. Now, the trend is very, very clear cut. The directional bias is remains very, very positive for gold. Okay. So this is oil. This is the WTI crude oil. Crude oil has actually uh, rebound quite strongly from the low of $56.40 per barrel. Is currently at 60, I believe at 63, $60. Okay. It's above $60. So for the month itself, it has been positive, but for the year to date, it is still in double-digit losses. So is it going to be pointing to higher oil prices? I think the market has stabilized and is getting ready to climb back up again. So this is the dollar index. You can see the dollar index continues to be losing ground. Now, the whole of 2024, we saw the dollar index gain 7%. It started very strong. Okay, you can see at the beginning of the year was 109.50 thereabout. And then this is of course after Trump won the election in November. So there was very, very strong push in the dollar. And in the early days of the January 20th, which was Trump's inauguration day, the dollar was still elevated, but since then it's all the way downhill. At the lowest point, it has lost more than 8%. So essentially what we're saying here is that the dollar has returned back everything that it gained for the whole of 2024 and is currently on the rope. Okay. Although we have seen the bounce back in the dollar as a result of the 90-day pause and then followed by the 90 days pause after the conclusion of the US-China meeting in Geneva, but you can see that the dollar index is now coming back down again. So is it going to be continuation to the downside, or it has already found a bottom at 98.64? Okay, later on when we go to the chart, I will show you why I believe we're going to see lower prices in the dollar. Okay, so let's talk about what's going to happen in the coming week itself. We have first the manufacturing PMI. Okay, PMI has actually gone flat, and this is manufacturing, and this is the estimate is going to be no change for the month of May. In April, it was 48.7 after briefly staying above the 50 line at the beginning of the year. Now it is back down. Okay, it's expected to see, not sure what to expect because there was this front running of inventory. So maybe there is an uptick in manufacturing leading to the Liberation Day announcement. So we have to see this number. Okay. Then we have the ADP employment change. Again, this is a private number. They do expect employment to be still positive. Okay. In fact, it's so positive they expect a doubling of what was done in the month of April. So this is a very, very rosy outlook. Not sure whether it is justified, but if it does, then it will have spillover effect for the non-farm payroll on Friday. So this is the other purchasing managers index, which is the services, and we can see that it has always been the one supporting the US economy. And we can see that market expectation is that it would inch up a little bit from 51.6 in April to 52 expectation. And if this number should dip back into zero, it will be catastrophic because the one that's holding up the US economy has been the services sector, not so much the manufacturing. Okay. It's just going to be very difficult to bring back manufacturing purely because there are certain sectors that does not make sense to come back to America, okay? Unless we're talking about high-tech manufacturing such as, not sure what, maybe aircraft, for example, or military equipments. But it's going to be very, very hard to bring back manufacturing back to the States. What President Trump has been talking about to bring back manufacturing to the States can be interpreted as another way. Okay, instead of bringing back manufacturing to the United States, it could be another way of saying that he wants basically to destroy Chinese manufacturing. Okay, by making it difficult for the Chinese to export into the United States, which is big market. Okay, so China has been progressively reducing the exposure to US consumer markets since the 2018 trade war started by President Trump during his first term. So now it is still massive, but it is not as massive as before. Okay, good thing Trump didn't win the the election which was won by President Biden. Because if he had won, okay, China may not necessarily have the breathing space to retool. Okay, so now he's coming back for the second term. The Chinese definitely are prepared for him. Okay, so again, this number here, it will be a disaster if it dipped below 50, because like I say, the services sector is the one that's propping up the US economy. Non-farm payroll expectation, we do see a possible reduction in total employment, excluding non-farm. Okay, so here, uh, very contrasting to the ADP employment change. We expect to see a doubling of employments in the private sector. Here in the non-farm payroll, they do expect to see a dip from 177,000 to 130,000. Unemployment rate is likely to stay at current level at 4.2, but there is a risk to the upside. Okay, we have been hearing a lot of companies doing layoff. Okay, especially even in the space of AI, whereby companies are not necessarily reaping the benefit of AI, but they are laying off workers so that they can save money using AI. Okay, so we continue to watch this space. Okay, so as far as work wages are concerned, the workers' wages, they do expect month over month to inch up a little bit from 0.2 to 0.3%, but it has been basically quite. Okay, you can see the green line here has been very much stuck below 4%, okay, or rather 0.4%. Okay, it has not been great, okay, but it has found a bottom. You can see that 0.2 has been the bottom throughout the whole of last year and as early as last month. So 0.2 increase is not much gain compared to the inflation that these people are still facing at in terms of food and housing. Okay, so definitely it is not a major improvement. If this number doesn't pick up dramatically, it means that US consumers definitely will not be in a position to spend more. Year-over-year number seems to be also declining. You can see that it has been steadily been climbing from the peak in November of last year. 4.2% year-over-year. You can see that the last number is was at 3.8%. Now they expect this number to dip further to 3.7%. So if you view the earnings, okay, workers' earnings on the year-over-year basis, they have been declining. Obviously, this is a true reflection of the inability of US consumer to actually ramp up consumption in any meaningful way. So this will eventually show up in the GDP numbers. Okay. Right. Let's go into the chart itself. I see there's a question here. Let me get. Dennis is asking, looks like there is no significant event for May 19. Let's look back as to whether there has been anything significant. May 19, we have that dramatic move after the US-China meeting in Geneva. Okay, so that has actually set the stage for uh, for a rebound in the US equity route that we saw. Okay, uh, it was just a date for me to be more aware of what possible things may happen. Okay, whether it's on the economic front or whether it is in the geopolitical front. Okay, good thing that nothing much happened. We don't see dramatic move in asset prices across the board. So being wrong is not good. Okay, I just want to highlight certain dates just so that I can be aware and to be a little bit more observant as the date approaches. Okay, now we are moving into June. June is going to be also going to be quite dramatic. I don't have dates in mind for June, but I do believe that the geopolitics is going to get nasty in the coming days. Okay, now let's go into the price chart itself. Okay, keep the question coming. I want to also show you the monthly time frame. So this is the Dow Jones, okay, monthly time frame. The underlying bias is still to the upside, especially after April recovery from the low of 36,500. Okay, so this month we have a marginal gain, not much, not dramatic, okay, but it did register a marginal high compared to April, setting the stage for, technically speaking, a breakout to the upside. Okay, so technically speaking, equity markets, as far as Wall Street is concerned, it does looks positive from this perspective. Okay, in the weekly time frame, you can see that it's it's looking it's looking perfect. Uh, of course, we cannot rule out the possibility that we can see another dip because in my mind, this pullback from the high of 45,153 does not looks complete. Okay, it looks a little bit messy to me. Okay, ideally, what I would love to see is a three-way pullback into the lower ends of 32,000. Okay, but based on what we've seen so far, it is possibly likely to see higher prices rather than lower prices going forward. Okay, because this move here is actually quite dramatic. But here we have an overlap. The key to me is this level low. Okay, the low is 41,756. If this is very, very impulsive, the rebound should not overlap the low here, which is 41,756. But the market has gone up to 42,900. So it has overlapped. So it eliminates the possibility of another drop below 36,500. In that sense, it's a little bit messy. I would have loved to see this not overlapping this low here. Okay. But it did. So on a weekly basis, it does suggest that we possibly will be seeing higher prices rather than lower prices going forward. Right now, the market seems to have hit a pulse. Okay, the rebound from 36,500 unfolds in a three wave, hit this pocket of prices between 42,300 to 43,300. So we can see between this 1,000 point range, the market seems to hit a pocket. Okay, so this is a three wave rebound. I need to see prices extend aggressively beyond 45,100 to actually confirm that the market is getting ready to break up to the upside. Okay, so far in the Dow, it is not as bullish because the weakest link right now in the US major equity index seems to be the Dow Jones. Okay, so nothing to see here, and in that sense, maybe I'll move this somewhere else. Okay, now I want to also look at the S&P 500 on a monthly time frame. Monthly time frame, the S&P 500 definitely looks like it is getting ready to burst to the upside. Okay, the high so far is 61,000, just under 150. Okay, so based on the closing in May, it is definitely more positive than the outlook on a monthly time frame for the Dow Jones. So S&P 500 definitely is getting ready to 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 actually zoom to the upside. So if there's going to be any breakout to the upside, I think it's likely to come from the retail index, such as the S&P 500. Let me get rid of myself. So here is the weekly. So we can see the weekly time frame from where the market traded to the high at 6,000 to the high all-time high at 6,150. It is only 150 points. So it is very, very doable. All we need is just one positive feedback to get this market beyond 6,150. Okay, so the Dow Jones, the S&P 500 looks decidedly positive. In the daily time frame, you can see that the move here has hit a pocket at 6,092 and end up as a long-legged shadow doji. So this being the case, near term, there's likely to be some bit of a consolidation, but by and large, it does suggest that the market now has no counter trend on the daily time frame. The market is purely bullish, okay, except for this Thursday's closing, okay, which end up as a long-legged shadow doji, which suggests that the market is unsure where to go next, okay. But other than that, the momentum suggests that maybe we will see a real challenge of the all-time high. Very, very possible. Okay. So in the Nasdaq itself, is also very positive. You can see Nasdaq is just a hair breadth away from the all-time high of 22,254. So while it still have a counter trend in place, but on the lower time frame, there was no counter trend. The market is getting ready to 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 rock and roll. Okay. So 22,254, it looks like it may be taken out somewhere in June. So look out for that. So same thing for the weekly time frame. There's no counter trend. The market now is getting ready to take out the 22,254. Okay. It does looks like it is going to do it either in the coming week or if not somewhere in June. So in the daily time, in the daily time frame, it's not as strong. Whereas the S&P 500 end up with a long-legged shadow doji. This is decidedly a more bearish outlook. 21,820, it was a high on Thursday. It ended up as a shooting star, which is not great if you look at it from this perspective. Okay, so more likely we will see near term, at least in the next 48 hours, maybe a bit of consolidation, maybe perhaps even to the downside. Okay, but overall we can see that the market here is so strong. There is no, if you notice, there is no counter trend. Okay, so that is also one of the reasons why I think momentum wise we should be able to see a breakout to the upside sometime in June. Okay, of course, bearing the fact that there could be something catastrophic which is totally unseen. Okay? So next question, let me see what you have. Dennis asking, if Dow going for new high, does it mean dollar will strengthen due to demand? Not necessarily. The technical outlook for dollar actually looks weak to me. Okay. So what will cause Wall Street to go up and dollar to come down? I have no idea. Okay. But technically, it does suggest that equity market in the States is definitely going to be highly featured to the upside. Whereas in my mind, the dollar, I've just done the dollar index analysis for one broker, and the conclusion for me is that we will see further losses below the April low for the dollar index. I will come to that later on when I look at when we touch on the dollar index. Okay, so for Europe itself, Europe remains the place to be for equity markets because you can see that this is the monthly time frame. Looks very strong after the rebound from 7,531 in the FTSE 100. It is barely just underneath the all-time high of 8,909. So as far as the FTSE is concerned, UK equity market seems to be favoring the upside, technically speaking, although fundamentally there is no reason why the UK equity market should be going higher. But chart-wise, it does suggest that we probably will see a breakup to the upside as well. So this is the weekly time frame. You can see the momentum has been very, very strong. You can see every single week there's a new high compared to the previous week. So this has been ongoing since the market hit a bottom of 7,531. Very strong momentum. So in the daily time frame, we are also seeing there is no counter trend. Okay, so it does looks like not only Wall Street is gunning higher, European equity market is also showing strength, especially the European market. Now, the one that has broken in the new high is the DAX, which is the German index. Now, the German index has gone up largely because the current government running Germany right now favors more spending. In fact, they have already openly said that they will go into deficit spending, which is something we have not heard of for the last 80 years. Germany has experienced hyperinflation during, which led to World War One. Oh no, which led to World War Two. Okay, so they are very, very aware that they're very leery of inflationary pressure. But for the current governments to actually want to go into deficit spending, it has a lot to do with what's happening with NATO stand against Russia. Definitely, they are rearming. Okay, compared to Japan, which has been rearming for quite some time, the Germans have not really rearmed. Okay, because they have actually sit on the laurel, allowing the United States to actually provide the security umbrella. Now, with the return of Trump 2.0, the Europeans are not sure whether the US will be there for them. So they definitely want to ramp up spending on defense. They have actually been one of the most conservative in the whole of NATO in terms of defense spending. I think previously their budget for spending is nowhere near 2%. Okay, now they want to ramp it up from nowhere near 2% to 5% of GDP starting with this current term. Okay, so that will means there's going to be a lot of activity in the manufacturing sector purely because they are going to re-arm. Okay, so instead of producing goods and services, they are going to ramp up the production of weapon system. So that is also the reason why the German market has been so strong. Okay, but if you believe that wartime economy is beneficial, you can definitely trade to the upside for the German equity markets compared to the UK, which is economically doesn't make sense to me. But the Achilles heel for Germany, in my opinion, is the lack of energy, the lack of affordable energy. Okay, so if the Europeans wants to rearm, okay, uh, definitely they would have to find a solution for their energy needs. Okay, whether they're going to buy from the States or going to buy from Qatar, okay, it will also means higher energy prices. But right now, that is the only Achilles heels, in my opinion, for the ramp up in manufacturing for the whole of Europe. Last week, I did mention, right? Germany, for the first time, has sent station troops outside their own border. They have sent something like 3,000 or 5,000 troops to be stationed in Lithuania. And this is the first time they actually station troops beyond their own border. So something has changed. Okay. So that it leads to the idea that going forward, the situation in Europe is definitely going to be leading to something really nasty. Okay, so that could be one area to watch. If it does happen, how are we going to rebalance our portfolio to reflect the anxiety in the Europe theater? Okay, as far as June, the weekly time frame is concerned, it is positive, no counter trend at all. Okay, with the new high just been traded this past week. In the daily time frame, we saw that last Wednesday was an all-time high, 24,331.95, and looks like it is positioning for more. So Europe looks good for equity markets. Let's take a look at Asia. So as far as the monthly time frame is concerned, there is scope, but the problem for the Nikkei 225 has been all the while since last year, the 40,000 level. It has actually flirt with that level many, many times, but it has not been able to close on a consistent basis above these 40,000 levels. So as the market goes closer to 40,000, the same thing that prevent the market from going higher may still be at play. Okay, so going forward, if you have to do equity market, maybe the best place to be right now seems to be Europe, followed by Wall Street, and then definitely what we are seeing in Asia is not as bright. Okay, although it may go up, but I think instead of waiting for the market to break out, like what we saw in the on Wall Street and the European markets, you can see on the weekly time frame there is still that major trend that is suggesting further downside. The dominant trend is still favoring the downside for the Nikkei 225. Okay, although the rebound from 30,357 has been very impressive, but it looks like it has stalled for the last 2 weeks. So upside potential not as clear. Whereas in the lower time frame, for the daily time frame, you can see there was a breakout of this resistance line. Market may do a three-way pullback to retest this resistance and support somewhere between 35,600 to 36,000. So let's see over the next few days and weeks if the market do drift lower and whether this resistance and support line can actually hold. So definitely this current level at 37,667 is not the best place to get into the market. You don't want to sell this index because equity market seems to be suggesting upside rather than downside risk. Okay, and you definitely do not want to buy the Nikkei at this current level in the middle of nowhere. But if you do get a pullback into the mid 35,000, then maybe it makes sense because this line here is going to be very, very much watched by technical traders. Okay, over in Hong Kong is not doing fantastically well. Okay, we have a large degree three-wave pullback, no, rebound. Okay, from the low of 14,600 all the way to the high of 24,000, almost 800. Okay, and then it stopped. Month of April, we can see the market actually sold off, but it has recovered quite significantly. Okay, but the problem is that for the month of May, it only registered marginal gain. Okay, nothing to crow about. So there's no direction for the monthly time frame. Okay, but if you insist on trading the Hang Seng, we can saw that the market actually go up three wave, pull back very sharply, found a bottom at the lower end of 19,000 and bounce. Okay, so this area here is where the demand area seems to be. There's a lot of accumulated demand between 18,600 to 19,000, let's say 20,000. Okay, so this bracket of prices does appear to suggest that there is a lot of buying interest within this bracket. If the price ever slide back into this bracket, the people who bought up this market, okay, from the low of 19,000 may still want to buy. Okay, so this is my 2 cents worth for the Hong Kong equity market. Not the best place to be in right now, okay, if you're going to be bullish on equity markets. So in a daily time frame for the Hong Kong market, we can see that there is no counter trend, although one is in the making. Okay, so will this suggest we're going to see lower prices to 18,000? Not sure. Okay, like I said, earlier on in the weekly time frame, this bracket of prices 18,600 to 20,000 seems to be well supported. So if the price ever goes down to 18,000, it definitely will break below that area where I highlighted earlier on in the weekly time frame. Okay, so not the best place to be. Okay, Asia equity market seems to be lagging both the European and the American equity markets. Before I go any further, I want to take a look if there's any new question for me. No question. Okay, then let's go forward and talk about the dollar index. The dollar index uh, appears to be unfolding in a three wave. Okay, maybe I'll move myself to this side. Okay, three wave. Okay, if this three wave is an ABC move, equality is 94.5, thereabout. Okay, which is very close to this swing low here, 94.6. So there's a possibility we may see continual a continuation of this slide from 110 in the dollar index, targeting 94.5, thereabout. So based on this outlook, I think there is more scope to the downside for the dollar index. Then we go to the daily time frame. Here, the daily time frame unfolds in potentially a five wave. We can see that there's a 1, 2, 3, 4, and then if this is going to be five wave, this low here at 97.67 will be taken out, targeting anywhere between 95.4. Okay, and so further losses is expected, in my opinion. Technically speaking, this is looks to be potentially five wave. Okay, so for this to be a five wave, this low need to be taken out because the bounce back into 101.8 appears in the three wave. Okay, and this pullback could be the start of another leg to the downside, and the next leg could be very aggressive. Okay, because if this is part of a one, part of a two, and the next leg will be a third wave, which is going to be likely to be aggressive to the downside. So if we look at the 4 hours outlook, before the market goes down, there is still the possibility of a bounce first. You can see the internal structure here. There is a bounce from 98.58. So if this resulted in a three wave challenging the what appears to be the break of the support and resistance, anywhere between 100.88 to 101.3 seems to be a great area to look for potential reversal signal and sell the dollar index for another leg below 97.67. And if this low is taken up, that definitely the lower end of 95 will be seen. Okay, so that is the one reason why I think the dollar index is heading lower for now. Okay, however, I will not be able to share with you the catalyst that will see the dollar come off. Maybe the same catalyst that has seen the dollar coming off is going to be the same driver. Okay, so this is the euro dollar. So remember the euro dollar three wave decline, which is incomplete, is also shown up as a three-wave bounce in the euro versus the dollar. Okay, this past month we didn't see major gain in the euro dollar, but we also see that it managed to recover from the low. Okay, so this put it very much in favor of a test of 1.19 to 1.2. Okay, so long as this recovery to the upside targeting 1.19 to 1.2 do not exceed 1.23 half, and God forbid 1.22, 1.2555, 550. We should be able to see, even with a surge in the euro dollars, to have a high lower than the previous two highs here. Okay, so that will be very much in sync with the long-term outlook for the euro, which is for the euro dollar to crash below 95 cents. Okay, so I'm long-term bearish on euro. And especially the case if something bad really happened in the geopolitics in Europe itself. So this is the weekly time frame. This three-wave bounce, A, B, C, okay, looks like it will target anywhere at 1.19, which is very much already shown up in the monthly time frame. So further gains in the euro dollar, it is quite possible, technically speaking, to complete this three-wave equality rebound to 1.19. This is the euro dollar. Overall, the market is have a directional bias to the upside. Think this three-wave pullback ends the fourth wave. So in the near term, if I'm going to be long, this swing low at 1.1065 is going to be key. I don't expect it to come anywhere near or to even break this low. I would think that it will be trading to the upside. And the next wave could be quite aggressive. Okay. Um, Similar to the dollar index, before the market rally up, I think the market has a potential to pull back in a three wave. If it's going to be a three wave, then that will be a godsend, okay, to buy at lower levels. The market goes below 1.12. See if this is going to be where the fake move is going to happen. If the market do come down, take out this low marginally, and then reverse to the upside, that will be the key to go long, okay, in my opinion. This is based on the 4 hours time frame. In the sterling appears to be a lot firmer compared to, let's say, the euro dollar. Okay, so this past month we have a high for the year. Okay, at 1.3, just under 1.36. This is the sterling versus the dollar. So the two swing high here is going to be key. 1.42 half to 1.4375 not be taken out. Okay, to maintain the overall bearish outlook for the sterling versus the dollar. So this is based on the monthly time frame. There's a little bit of a scope to the upside. Okay, so we can see that this is also likely to be an ABC move. Who knows? Okay, if this is going to be a larger ABC move, that will be very interesting. If this is the case, we probably will see a move to 150, 180. 150, 180, let's compare to where the market swing high is. This is way above these two levels. So is it going to be likely to be such a play? Not so sure, because the market, it doesn't look very impulsive. It is gain ground, but it is basically dragging it higher, not in any impulsive manner. Okay. However, if I reposition it over here, maybe if it's end up eventually as a three wave, it may not be 151. Okay, it could be a 148. So 148 is even higher than these two swing high. Okay, so not sure how the sterling is going to play out. Okay, but the structure itself is not impulsive enough to justify chasing this market. So this is the daily time frame. No counter trend in place just yet. Okay, maybe one is in the work. Okay, from the high of 159, 135.90. Okay, so this could be initial part of that pullback, which may result in a counter trend. So if that's the case, look at the lower time frame. If you're going to treat counter trend, it's already shown up as one. It's the first leg of a potential A, potential B, potential C targeting 1.33 to 1.33, 30 to 1.3375. So this will be a good area to position long if you are still going to be remaining bullish on sterling. Okay, but we will have to see. Is there a better place somewhere else? Let's take a look at dollar yen. Dollar yen appears to be doing this ABC in the on the monthly time frame. If that's the case, I do expect the low here at 139.60 to be taken out, possibly into as low as 131.20 to 136 half. So that will be the ideal setup to go long on dollar. Okay, the yen is strong largely because market expect the BOJ to actually continue to high interest rates. Okay, so technically speaking, this three-wave move doesn't look complete to me. There's potential for dollar yen to go lower to at least 136.65 to complete this three-wave equality move. Still, basically, you can see the dominant trend is up. So as far as the chart is concerned, the higher time frame suggests that it is lower to buy. Okay. On the daily time frame is a little bit different. Okay. Day time frame does not suggest that it is lower to buy just yet. Okay. Because this pullback from 158, 159 levels has dropped down to just under 140 before it bounced back, okay, to 148.65, and it's currently coming down. Okay, so if I have to say near term is more likely to see further losses in the dollar versus the yen, but in a higher time frame, which is the weekly or the monthly, it suggests lower to buy. Okay, in the 4 hours, it is purely bearish. Okay, there's no green box to be had. So near term in the 4 hours time frame suggests that this could end up to be much lower, targeting at least 142. Okay, but if let's say we're going to do a simple three-way pullback, starting from the high here. Once the market breaks and close below 142.10, okay, it is likely to target much lower at 140. Here, the target is 139.75. Okay, so 140 seems to be a round number to be had. And if we compare to the daily time frame, 140 is not catastrophic. It is still within the allowable range here. Okay, meaning to say that if the 4 hours break go down all the way to 140, it is still a buy for the daily time frame because the point of invalidation is 137.25 or 24. Okay, so near term likely to see further losses dollar yen, but medium to long term continue to look for levels to buy. Let's take a look at Aussie. Is Aussie going to be where you want to put your money? Now, Aussie has a very strong performance in April. No follow through for the month of May, but it has already set the stage for further gain in the Aussie. Technically speaking, if this end up to be a three-way, there's a lot to go for it. Currently, the market is at 64 cents. It could go all the way up to 84 cents. That's 2,000 pips. Okay, so this is going to be potentially massive. Now, for that to happen, the dollar must collapse, which is also very much in sync with what I just mentioned in the dollar index. Okay, so this is the weekly time frame. Uh, it has not really slowed down. Okay, it has struggled a little bit, but this past week we have seen a marginal high at 65 cents. So this actually put it in a very good stage. If the market do pull back, look for level to buy. At least this rebound looks to be very attractive. Remember, 2,000 point potential on the monthly time frame. Daily time frame has already turned positive. There's no pink color box, purely all green. Okay, so the market has been struggling. Okay, since the market hit 65 cents. Okay, but doesn't look like it's going to come off in a big way. There's a lot of support here. Okay, so we want to watch how this thing unfolds. Maybe what you can do is do a simple support line here, and then take it from here. Okay, the price can stay above this red line here. I think it is lower to buy. Okay. Here, of course, the dominant trend is up with a bit of a pullback. So the market has been respecting this 64 cents. One dip, two dip, got bought up. Okay. So whether or not this will end up as a three-way to the downside, not sure. But if it does, it is again quite an attractive proposition to go long, in my opinion. Anywhere between 62.5 cents to 63 cents, I think is actually quite good to reposition for the upside. Kiwi dollars. I know this is not something that a lot of people of you trade, but since they are highly correlated to Aussie dollars, maybe we should also take a look at it. Okay. Now, very similar to what we saw in the Aussie, but also marginally different. This low here did not take out the previous low that we saw in 2020. Okay, it actually works as a double bottom. So this the 54 0.5480 level seems to be, or rather the 55 levels, 55 cents level seems to be a area of defense. Okay, so it looks like somebody is defending the 55 cents level. So it does provide a basis to trade to the upside. So this is the weekly time frame. you can see that this week itself, we have a marginal gain, okay, compared to the low here at 0.5485. So technically, it looks supported to me. Daily time frame, we have a bit of a marginal counter trend in place. Do not sell this thing. Okay, I do not believe this is a selling market because the dominant trend seems to be suggesting further upside potential. 4 hours, not sure. Okay, if it's lower, maybe it provides the opportunity to buy on the dip. If I do the three wave thing, so if we do get a three wave pullback, ideal level to go back in on the long side will be above 59 cents. Okay, 59 cents area will looks to be actually quite ideal. Okay, because there's a swing low here at 58.45. Okay, so if this comes back, it will work as another double bottom here, potentially. So lower to buy, in my opinion. Dollar Canadian. Let's take a look at the dollar Canadian. Dollar Canadian seems to have lost a bit of steam. Dollar is strong relative to the Canadian dollars. The high is 148. You can see 4 months of continuous losses, but the losses seems to have slowed down quite a fair bit compared to April. Okay, but it does suggest that maybe we will see further losses in dollar Canadian as well. Although the dominant trend seems to be in favor of the dollar relative to the Canadian dollars. So we have a three-wave pullback, and this pullback here looks to be extending lower. Immediate target is anywhere between 132.60 to 135. Okay, so if the market do go into this bracket, this is potentially working out to be a potential five-wave because this is represents the most impulsive part of this pullback from 148. Okay, dollar Canadian, you can see that this thing is unfolding as a five-wave. Five-wave, very neat five-wave. Okay, any bounce here should meet some kind of resistance at 140. Okay, so if any kind of bounce 140, this represents 1, 2, 3, 4, 5. It finishes five-way structure, looking to extend perhaps. Okay, but I think downside will be quite limited for now. Okay, however, if we do get a bounce back to 140 area, that could be a good area to consider looking out for reversal signals. Okay, I think I'm done with currencies unless you have further question for me. Anonymous is asking, not sure if you hear me correctly. I mentioned that the dollar index is looking further, but euro dollar, you're also looking for, yeah, the higher time frame, okay, for the euro dollar is bearish. Immediately, I think the euro have potential to the upside. So it's all based on time frame. The larger time frame in the dollar index is bullish. Although immediately, I think it has further to fall. Okay, if it falls, then it is only natural for the other principal currency to rally. So again, it's all about time frame. Okay, long-term time frame beyond the weekly and monthly time frame is very obvious. The euro is in a major bear market, and it's corresponding to the bullish outlook for the dollar index. So there is no conflict here. Okay, so when I say the dollar is likely to come down in the immediate future, that is the near term. Okay, whereas the euro versus the dollar near term is up, although the bigger picture suggests that we are still very much in a bear market for the euro versus the dollar. So I hope that can help clear up the confusion here. Dollar Swiss. Okay, this is dollar Swiss. The dollar Swiss is likely to be continue to lose ground. Meaning to say the dollar will lose ground against the Swiss franc. Right now, the Swiss franc is a currency of choice. Do you know that if you buy the Swiss franc, you got to pay the Swiss supplier? Meaning to say that in order to go long on Swiss, you actually pay swap. Okay. Now this is a bit weird because interest rate in the States is still very high at 4.5%. But if you're going to go and sell dollar versus the Swiss franc, it is very likely that you are going to pay swap. You buy, you pay swap, you sell, you pay swap. Because right now, the Swiss franc seems to be the currency in which people are parking their money, okay, for safety reason. Okay, want to remove this. Weekly time frame, I think further losses are ahead, meaning to say further gains in the Swiss franc. So this is very much in sync with the weak dollar outlook immediately. Okay. So we have a triple top here. Market has not been able to go meaningfully above 92 cents. And now it went up to as low as 80 cents. Have a bit of a bounce. Now it looks like it's resuming to the downside. So near term, this drop here does not look to be over. We have a bare minimum three-wave bounce, and then now market is coming down. If it's taken out the 90, the 88, the 80 cents low, it's going to extend lower. So outlook for the dollar versus the Swiss franc continue to favor the Swiss franc over the dollar. I hope that has been good enough. Let me go down to the commodities. Let's start with gold. Okay. Now gold, after a massive run up in April to 3,500, appear to be stalling for the month of May. Gold did not gain a lot of ground, but it also did not lose a lot of ground for the month of May. For as far as gold is concerned, it's neutral. You can see that this is a doji. So it does not provide us with much information as far as May is concerned. So if that's been the case, won't be surprised if they continue to consolidate. But as we go into June, again, watch out the geopolitics. Because gold doesn't need a lot of excuse to go higher. All we need is an escalation of the geopolitics is enough to send gold surging again. Okay. So this is the weekly time frame. We can see that there's a bit of a pullback, hit 3,120, bounce. Now this past week we have no new high compared to the week before. So that does not provide us with a lot of information. However, if you go down to the lower time frame, this looks different. We have a bare minimum three-wave pullback, which is equality move at 3,120, bounce back to 3,365. Now it's kept below this resistance line, which I have mentioned previously. Unless this market close above this red line here, which is the resistance line, further gains could be kept. But this is nickel. So could this end up with a more complex corrective pattern? We have a bare minimum being done, three wave. Can it evolve into a double tree? I mean to say another set of three wave below the 3,120. It's possible. Okay, but if it does unfold as a double tree, means two sets of three wave from the height of 3,365, then we should expect another down move below 3,121, possibly to go into this bracket just under $3,000. Okay, so I do believe $3,000 being a very nice number should attract a lot of buying interest, because that will mean that from the daily time frame, this provides the 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 the, the best trade setup to go back in to buy the dip. Okay, because all we need to do is to put our protection here below 2,832. If the market can come into this bracket, prepare to lose slightly over $100 per ounce, and take your chance from here. Okay, I think I will do that. So this is the 4 hours time frame. You can see the market has been having lower highs, lower lows. So here the point of invalidation is 3,154. If this result in another pullback below the 3,120, that we reverse back to the daily time frame. Okay, let's take a look at the silver market. Silver is struggling, but it is confined within a three-wave bounce. Okay, this past week seems that silver is marginally outperforming gold. Okay, and this is a very subtle change in their sentiment. So this bounce from $11.62 is very corrective. So top side is going to be pretty limited for now. Okay, $36 to $40 is about all you can do for now. Okay, of course, if the market close above $44.21, that will be a different story. But for now, it does look to be a corrective rebound. So if you have not already bought, this is possibly not the best place to be buying. Okay. Silver have a three-way pullback hit equality at $28.34, bounce very strongly. If this is going to be the end of the corrective pattern, okay, from $34.86, then this high here is not defensible. Okay, it's likely to be taken out. Okay. The daily time frame, the point of invalidation appears to be here, $34.57. Okay. So if I have one, two, three, four, looks like another new high is coming above $34.86. Okay. So this will be, in my opinion, the third. Okay. If that's the case, this could be the third. We have finished the fourth three-wave pullback on the daily time frame. Is getting ready to rally. Okay. So it all depends on your outlook. Okay. My target is $37.12, which is not a lot. But consider that it's just under $33 right now. Maybe it's worth considering. Okay. But this is the end part of this move, all the way from $17.54. So once the market take out this high here, $34.86, okay, look out for divergence in the RSI as well as the stochastics or even the MACD, because divergence usually appears in the fifth wave. So the end of this move here, followed by a divergence in the indicators, okay, is usually quite accurate. Okay, so look out if the market ever take out this all-time this high at $34.86, uh, deploy the momentum indicator. It should be able to provide some kind of advanced warning. All right, let me take a look at oil market. Unless you have question for me, looks like you have. Uh, Alan, you're asking me what's my view on stablecoin. Okay, that would be a different subject altogether. I think over the last week or so, I did mention there is this act that's passing through Congress called the Genius Act. Okay, I have my views on why they are launching stablecoin right now, tied to that is backed by 100% either the dollars or the US Treasury. Okay, so maybe give you a little bit of background. We all know that this whole year we have seen U.S. Treasury being sold off, or rather, a sell-off because other economies such as Japan, UK, and China are having to show up their defenses. I mean, their finances back home because of all this tariff war, right? So Japan has already acknowledged that they have sold a bunch of treasuries, okay, because their own bond market now has no demand. Now, in the Japanese market for 30 years, the Bank of Japan has been the buyer of last resort. So much so, the Bank of Japan represents 52% of all buying in Japanese treasuries, okay, the Japanese government bonds. Now the interest rates are going up collectively between the Bank of Japan, the pension funds, and the savings banks. They are holding on losses in excess of 45%. So they're all losing money based on their holdings. Okay. So they are not in a position to continue to buy. So in order to support not only the dollar yen rate, okay, they would have to find money, okay, to support their own bond market. And the only place where they have a lot of excess money is they are all parked in US treasuries. So last month we knew Japan didn't do well in their auction for the JGBs, which is the Japanese government bonds. So likewise, in the States, the US Treasuries, especially for those 20 years and 30 years to the longer end of the bonds, has received very little demand. So now the Federal Reserve is also not buying because remember they are in the process of doing quantitative tightening. Okay, so the U.S. Federal Reserve is not buying, the Bank of Japan is not buying, okay, and that result in less demand overall. But what we do have is coming June, okay, U.S. needs to refinance as much as $6 trillion worth of short-term treasuries. So if there's no demand and upcoming within weeks, we're going to have to refinance short-term treasuries, meaning to say that the US Treasury needs to issue a lot of treasuries, but they need to issue it at much lower yield, which is not happening because the yield now is on the upside. So the stable coin thing that is currently working its way through Congress, once that is passed, the stable coin, okay, outwardly says that they need to be pegged to either the US dollars or the US Treasuries. Now remember, the US Treasury used to be owned exclusively by institutions and central banks. Very little support comes from the retail investors. But with stable coin, that could change dramatically. Now, if you have ever used stablecoin, whether you're paying or whether you're receiving, okay, I had received payment in stablecoin before, okay. So stablecoin, to a large extent, are a godsend to people who want to do money laundering because you cannot trace it, okay. So now with this Genius Act they are passing through, they are allowing, okay, questionable funds to come in to buy treasuries, whether it's legit or not so legit, okay, they welcome them to hold on to stable coin so that at the end of the day, the issuer of this stable coin, not the Federal Reserve, the issuer of this stable coin, okay, needs to buy treasuries to back it up. So for the first time, if this Genius Act get passed, this stable coin, okay, will be a conduit to create the demand which is lacking currently for treasuries. So the stable coin to me is a conduit. Now, if you want to put another thing together, recently last month, okay, Donald Trump says that for any kind of gains, or no, any repatriation, okay, there's a lot of people holding green cards, especially the Indian and the Filipinos, okay, they send back money that they earn in the States back home. It's called repatriation, okay. Donald Trump want to charge them 5% tax. However, he also mentioned that if you do not want to be taxed 5% on every dollar that you send back home, you can convert that by using stablecoin. So he is providing one stick saying there's a 5% tax. And then on the other way, he's providing you an avenue. It's like you shepherd your sheep to go in one direction. Okay. And more and more people buy stablecoin. The issuer of stablecoin need to issue even more, and every stablecoin they issue need to be backed by treasuries. This is in one way to create the demand to avert the potential catastrophic crisis coming up in the next few weeks. And the timing of all these legislation are passing through, okay? For the Stablecoin Act, which is the Genius Act, should know very soon, okay? Maybe as early as next week, whether it will get passed, okay? Is one big money game, in my opinion, okay? So that is my view. And that is going to be competing with gold. There are also talks that the US treasuries holds a lot of gold, 8,000 tons, but they were all priced in 1973 prices, okay, $24.22 per ounce. And if they mark up to the current gold price, which is above $3,200 per ounce, that represents a windfall, okay, which could be used, not sure what they can use it for, maybe to create the sovereign fund that President Trump wants to create. So I think gold is not directly tied to stablecoin in that sense, okay? Gold driver is totally different. Whereas stablecoin, I think, is created for the convenience of creating the extra demand to buy treasuries so that the US government can continue to borrow more, issue more treasuries, because the Federal Reserve said they are not going to lower interest rates. And that would be a problem for the US Treasury. June is one period we have to watch. The next one will be September. And then the last few months of 2025 because the corporates are also needing to refinance. So these are all the background drivers that you want to be aware of. Just continue to monitor the news coming out, okay, for this area. Anonymous, what a plan Trump has come up with. I don't think it's Trump. Trump is not as bright. It's the people around him, okay? And Trump is definitely trying to goose this stablecoin thing, okay? Now, Trump, when he came in, before he was inaugurated, he launched the meme coin, the Trump meme coin. And his second son is running the Liberty Finance something, okay, which is a cryptocurrency fund, okay. The Qataris has actually invested a lot of money on that particular coin, okay, to curry favors, okay, with the Trump family. If these stable coin bills get passed, the Trump family stable coin, not stable coin, is going to issue a stable coin called the USD1. Okay, the Qataris government has actually put money into this, okay, through Binance to support this coin. So the Trump family is definitely in the business of trying, to profit from this move. Okay, so it is something never been done before. So we want to continue to watch. Okay, can you can you write the coattail of this move? You can because it does looks like um, when they issue stablecoin, it's no longer the Federal Reserve anymore. Okay, this is also another way to bypass the Federal Reserve altogether because the Federal Reserve is not playing ball. Okay, they do not want CBDC. They are not looking to lower interest rates. So that frustrates the Trump administration because they need yield to come down. Okay, so he said, okay, if you don't want to play ball, I create something else totally beyond your control. Okay, and stablecoin is that conduit to this thing. Okay, so this is what I think is really happening. Uh, Anonymous say, well, what a plan Trump has come up with. Have to give it to him for some levels of brilliance, linking stablecoin to the treasuries indirectly with the money remittance and the debt. Yeah, I think some smart alecks come up with this idea. Okay, so definitely it will be seen to be very positive for digital assets. But for Bitcoin, you got to be very, very careful. I think there is a overhead pockets around 120,000 to 125,000. Okay. So as far as Bitcoin concerned, if this news pick the digital assets prices higher, watch out for Bitcoin. I think somewhere between 120,000 to 125,000 could be a air pocket. Okay. Whether they can punch through or not, I seriously doubt. Okay. At least not in the first attempt. Okay. I want to talk about oil. Now, oil market has been coming down. As far as this oil is concerned, you can see that the high is 126.5. It does not look to be complete yet after April sell-off. May has been more or less in consolidation, but the low is below $55 per barrel. Can it go lower? Technically, yes. Okay. Technically, the market can go down to $31.50. So you can see that there is another low here. This low here is $33.80. Can it go as low as that? Okay, we do not know. Okay, that was after the pandemic sell-off, market recover. Are we seeing another pandemic on the horizon? Possibly. Okay, and if that result in something drastic like a lockdown again, oil prices could easily go down. Okay, because that will means the global economy is going to be shut down once again. Okay, so not sure whether this will be the catalyst, but technically speaking, it does appear that there is likely to see further losses ahead in crude oil. Okay, so do not go into crude oil just yet. Okay, I think at the bare minimum, the bounce that we see so far to $60 from a low of $54.70. Okay, it's likely to be just a minor bounce in the weekly time frame. Not enough to create the condition necessary for the market to sustain higher. In the daily time frame, this three wave is even more apparent. Okay, just marginally above $64.70 could be the top already. Okay, so do not go into crude oil just yet. All right. I'm gonna move myself. Let's talk about Bitcoin. Now, the monthly time frame suggests that this thing has already taken out an all-time high for the month of May, 112,000 thereabout. Okay, so in my opinion, I think there is that scope for 120 to 125,000 before it needs to clear that overhead, because we are now in uncharted territories. Nobody know how far it can go. Okay, we have people telling us Bitcoin can go into the upper end of 1 million. So not sure. Okay, it could be. Okay, but then again, it's just too speculative. So you want to be very careful trading the Bitcoin. So near term, on a weekly basis, this past week we are having an inside bar. Of course, we still have 3 hours to go before midnight, so it could still be something else. But for now, it looks like an inside bar. Okay, meaning to say there's a chance market may dip. If it dipped, the immediate level of support appears to be this bar here. The high and low of this bar is 92,800 to 97,850. Okay, that will be the nearby support. But overall, it does looks very well supported. Okay, it is definitely technically speaking in the gold phase, in the bull phase. Okay, so potentially bullish for the Bitcoin. Ethereum is a joining come lately. You can see April for May it has a major run up. Now Ethereum has actually missed out on all the big move, okay, in the digital space. But like I said, it's a joining come lately. Lately, you can see that Ethereum prices seems to be in focus. Okay, would it result in lower prices? Not sure. Generally speaking, this thing is very bullish. The pullback here does not look complete to me. So there's always that risk of further losses below $885. But overall, it does look to be positive, lah. Okay. Near term, not near term. I think medium term for the weekly time frame, the nearby support is this bar here. We translate to 1,730 to 1,871. Okay, no clear sign, but I think overall, this rebound that we see possibly have room to go higher. And if it does pull back, it will be a bonus. Okay, there's no such thing as there's no low risk trade setup available. This is Solana. Boy, Solana doesn't have a lot of history. So we can see that dominant trend is up. We still have the pullback that after May, we can see that it's likely to point to the downside. Okay, likely to point to the downside. This week is actually quite a bearish setup. So I won't be surprised based on the monthly time frame, we can see a move below 95 cents, $95. Ripple. Ripple has not really moved in a big way just yet. This is the daily time frame, appears to be consolidating with the possibility of lower to buy. If the price can drift back to below $1 60 cent, that will be a bonus. So far, the $2 has been holding up very well. Okay, so we can see that on Saturday we have a test of $2.07. Okay, so the market drift lower, $2 seems to be well supported. No clear direction here, but we do have a three-way pullback with a low at $2.07. So maybe the pullback is completed, getting ready for a new pattern. Okay, let me see if anybody has any new question for me before I call off the day. Okay, that's it. Anybody has one last question for me? Don't have? Okay, for those in Malaysia, I'm going to give a talk on the 21st uh, in PJ area, okay, near the curve, I believe. Okay, I'll be giving a talk for Kenanga. So if you are going to be around and you want to join me in this physical event, you got to go to Kenanga website and register for the event. They haven't given me the link, so I don't have the link for you. What is go direction next week? You're not listening, Sam. Okay, let me revisit gold. Now, gold, let me start with something nearby. Okay. Now, the high, all-time high is 3,005. Market did a three-wave pullback, fulfill its bare minimum corrective pullback, meaning to say that market is getting ready to resume its uptrend. However, we saw this past week, the market could not break above this resistance line. I need the market to close, not only break, it must close above this resistance line. For me to have confidence that the market is going to go next to take out this 3,005. So far this week, the market has respected this resistance line, suggesting that they may evolve into a much more complex corrective pattern. Earlier on, I did mention double tree, right? Double tree means one set of three wave followed by another set of three wave. And if that can result in a pullback all the way to below $3,000 per ounce, that will be a perfect level to go in to buy it. Okay, I will be a buyer if the market does this. Okay, ABC compete as A, B, C, targeting just under $3,000. If the market can do that, I am definitely a buyer because there's a swing low here. And if I can keep my stock below $2,830, that will be a play for me for the potential to break into all-time high. Okay, so this is based on the outlook based on the daily time frame. In the lower time frame, such as the 4 hours, you can see that the market is doing a minor three wave. So far, you can see that the high here has not been able to breach this red line, which is the resistance line. Okay, and then we can see that the market is doing this, potentially going lower to below 3,245, perhaps into 3,180 to 3,210. That would be the technically the best place to be because without taking out this 3,154. Okay, but if the market did take out this level, then I refer to the daily time frame. Okay, unless the market take up $2,833, I am not going to be selling. It does looks a potential trade to be selling, but never sell gold. Okay, if you have not already bought, then look for levels to buy, and there are only two conditions to buy. If we have a breakout of this resistance line and a close above it, that is for those very aggressive individual among you, then you can chase. Otherwise, you allow the market to drift lower, okay, to the lower end of 3,000. Yep. So that will be how I will be playing the gold market going forward. I think there's one more question below. One more question. Let me take this last question. Short term means how long? I've shown you the lowest is 4 hours. That will be my short term. So again, this is very personal. Your short term could be 1 minute, but I don't trade the 1 minute anymore. Okay, it's just too intense for me. So for me, all the time frame that I've shown you are the time frames that I do watch. And if I have to do a trade, short term means for me, no lower than 1 hour. Okay. Okay, thank you guys. And like I said, I will keep you updated, maybe perhaps next Sunday or the Sunday after that, as to how to register for the Kananga seminar. It's going to be 2 hours. I'm given 2 hours to speak, so it's going to be a pretty long session. So if you're interested and you happen to be in KL, you're more than welcome. It's free anyway. Okay, guys, I'll see you next Sunday. And in the meantime, happy hunting. Bye bye. Take care.